This is Chip Morrison from my Connect Pal account. What do I do? Hey, I was asked by Brian the other day if I could share a few ideas as it pertains to investing in real estate. Well, Brian, I'm happy to address that. And subscribers, I got a few ideas for you that you might want to take out a pen and piece of paper and jot down. We'll talk about the first three most important things that every investment needs to have for you, and that is it needs to make money. You need to have fun at it, and you need to be happy at what you're doing with investing. Now, the part about making money takes a little bit of time to explain some things that I think you need to know. We'll talk about, again, some general rules, some basic terminologies. I'll give you some things that you ought to consider when investing in real estate. So get the pens and pieces of paper ready. Here we go. All right, some general terms of investing in real estate. The number one thing you need to understand in investing in real estate, the number one rule is don't lose it. Now, after you've accomplished that, you certainly want to make more money with it. And the third thing you need to do is make even more money with it. The fourth rule that I would give you is the old Las Vegas rule. Once you've gotten your original investment back, put it aside and play on your winnings. And the fifth thing is, once you learn to do it successfully, duplicate yourself and your efforts through the helps of other people. Now, some basic terminology that you need to know when it comes to investing in real estate. Well, the first thing you need to understand is how do you value a investment? I like to use a little formula I call IRV. Income over rate equals value. The only problem is you need to learn what kind of income here we're talking about, because there's lots of different incomes. Terminology: gross income plus other income is adjusted gross income. What is other income? You own an apartment complex and you have washer and dryer revenues that come in off that. That is considered other income. Cell tower on some property, other income. Now, the adjusted gross income less credit and vacancy losses is your total net income. Credit and vacancy losses. Well, hey, if you've got a quadruplex building, all four of those apartments may not be full all the time. So you want to have some credit and vacancy in your numbers to make them more realistic. Therefore, you might show a 20% or 25% in this case vacancy loss before you start getting into where your money and your profit is going to come from. So if we take adjusted gross income and take from it credit and vacancy losses, we have total net income. Is that the income I'm talking about for IRV? Nope. We take from total net income all of the operating expenses. Once we do that, once all the operating expenses are taken from total net income, we then have NOI, net operating income. And that is the kind of income that we're looking for in the IRV formula. Now, if you wanted to even take it a step further, net operating income less debt service, if there is debt service on a property, gives you what we call cash flow before taxes. One of the reasons I think IRV is a good formula for people to use is because it doesn't take into consideration any debt service on the property. Another very simple formula is also called cash on cash. If I give you $1 today and a year from now you get $1.20 back, do you consider that a good return on investment? Both of those are simple and easy things to understand. Now, some cautions in real estate. First is don't get greedy. A lot of people that make a lot of money in real estate do fall into this trap because they want to push their limits on certain properties. Don't get greedy. You have a plan going in, you have a plan going out. When that plan is executable, get out of the property and move on. Do not invest for merely tax benefits in a property. Tax benefits should be an additional value of being in an income producing property, but should not be taken into consideration when you're looking in terms of the kind of reasonable return you want to see out of an investment. Also, number 3 is I want you to be very careful with leverage. Leverage is debt against a property. Yes, it allows us to buy more than what we might normally afford, but debt can also get us into a lot of trouble down the road. 4th thing I want you to remember is do your homework, okay? Do the inspections. Check title. You need to check the public records and see if there's going to be any road expansions nearby. Definitely check the taxes and see that they're not going up. Make sure that you don't have any deed restrictions. In every one of these instances, in 44 years of being in the real estate business, I can tell you we have found people that have unfortunately gotten themselves into terrible situations because of some of these things that I've mentioned to you today. 5th thing is you need to make money in real estate income producing properties by 3s. You need to have cash flow, you need to have appreciation, and lastly, if there are some tax benefits because of an income producing property, you need to get those as well. The 6th thing you need to remember is even though I am totally knowledgeable about what I do in the real estate business, there is no way that I would manage my own properties. Every piece of property is farmed out to professional management. You need to do the same. The 7th thing I would tell you is run your numbers on what you expect best to happen to this property, what you pretty much think is going to be average with this property if you buy it, and I want you also to produce what I call a survival budget. A budget of a number that it's going to take for you to service this property and carry it to the point that you sell it and actually get out of it. That's called your survival plan, and you need to have one. 8th thing is you need to only, let me repeat this, only use straight line depreciation when you're depreciating an asset that's income producing. There are lots of different types of depreciation out there, okay? Some of the years digits 200%, 150%, 125% declining balance. You can also take the depreciation and we can depreciate income producing assets on what we call a composite or component. We can go through and break out the appliances and they would have a separate schedule to it versus maybe the entire building less the appliances. The point is that use no other method of depreciation other than straight line. I've had people in the past, again, 44 years of experience, that have used what we call accelerated forms of depreciation and have come back to me and asked me in very short periods of time to resell the property. And unfortunately, because they took accelerated forms of depreciation, we have a thing called depreciation recapture that gets back so much of the money that they thought they were going to save that it made it almost completely prohibitive for them to even consider selling that property. The 9th thing I want you to know is you need to find a great tax accountant that specializes in real estate. H&R Block isn't going to do it for you. You need to have somebody that has a great familiarization with real estate and real estate income producing properties for your tax returns. And the 10th thing is know when to say no. Know when to walk away from something. You should never get into an investment that makes you feel uncomfortable. If your gut instinct is telling you one thing and your numbers are telling you something else, go with your gut instinct and take a walk. Now, some issues that do deserve consideration where people in income producing properties get themselves into a lot of trouble. There is a big difference in the investment world between what we call a dealer in real estate and an investor in real estate, particularly about how they're taxed. Dealers are taxed at ordinary income rates. Investors are taxed at long-term capital gains rates. Now, depending upon your particular tax bracket today, you may fall at a 15 to 19% capital gains tax bracket. If you're rehabbing houses for the production of income, buying properties, rehabbing them, flipping them, you're going to fall into a dealer category unless that flip from the time you bought it to the time you sell it is more than a year and a day. What does that mean to you? Well, let's say you make $100,000 a year, and let's say you make a $50,000 profit on this income producing property that you buy. You're not going to be taxed at $100,000. As a dealer, you made $50,000, so now your tax bracket is $150,000 in which you will pay taxes on. It's what we call upping your bracket with the IRS. Now, if you were an investor in income producing real estate, not a dealer, and you were in that 15 to 19% capital gains tax, then that means that you're only paying 15 to 19% of that $50,000 you made, say $7,500. So now you'd only be taxed in the $107,500 tax bracket. Big difference. Big difference. A lot of people get themselves into trouble with investor versus dealer. You need to know what those tax consequences are before you get into investment in real estate. Also, you need to decide whether you want to use corporation partnership, subchapter S corporation. I highly recommend using a thing that's very popular today called LLC, limited liability corporations, because they have all the advantages of corporations, but they're treated like partnerships. And if you're a sole member of a LLC, it means that you do not have to file a separate tax return, that it actually can show up as what we call a K-1 report on your personal filing. The last thing I'll tell you that needs to be considered is you need to stay with what you know. Stay with what you know. I have plenty of people that I admire in the investment world that do very well in the industrial market or very good in the office market. They're not going to go out and buy something residential. Stick with what you know. Okay? If you want to look at one of the most interesting investments that you can make long term, which is not necessarily income producing unless there's something income producing on it, is land. Land is one of the greatest single investments that you could ever make. It's one of those things that you could buy today and sell 20 or 25 years from now. I have seen in my 44-year real estate career, people make more money on land, good pieces of land, than any other thing I've ever seen in real estate. Some of them have bought land for as cheap as a couple of $100 an acre, a couple of $1,000 an acre, and then 20, 25 years later have resold after rezoning that property for $250,000, $350,000, $500,000 an acre. Yes, they didn't necessarily have anything income producing on it, but from the standpoint of an investment that, if you're looking long term, will generate you a huge amount of money, consider land. And consider land at the intersection of two streets. You'll thank me for it later. Hey, now we've talked about making money. What about having fun in this business? If you're a husband and wife, having fun is working together. Having fun is making money and taking some of that money and obviously putting aside for future things that you want to do, future investments, but take a little bit of it and spend it. Go on some trips. Invest in some things that you too want to have. That's what I mean about having fun in this business. And last thing is be happy. Now, happy is a state of mind. It is a choice that we make every single day. I hope you make that choice. I hope these things have been important to you. I hope that I see you not in the too distant future in one of my investing in real estate programs. Hey, my time's up today. Thank you guys for yours.